On September 15, 2008, the lights in Manhattan looked normal. Taxis hissed through rain, and coffee steamed behind glass. Most people thought this was just another rough Monday in the market. It wasn't a panic yet, because the ledger hadn't screamed in public. We think economic collapse is a storm that arrives overnight, a crash, a headline, a villain in a suit. But collapses don't begin with fear, they begin with arithmetic and the slow discovery of insolvency. A nation doesn't fall when armies breach the walls. It falls when its balance sheet turns and refuses to turn back. That's when liquidity becomes a prayer. That's when confidence becomes a hostage. That's when bankruptcy stops being a word and becomes a room. If you want a picture for that room, look at the Lehman Building on that same day. The stone still stands, but the numbers don't. Steel can stand upright while a company becomes a corpse. Here's the inversion that matters. People say Lehman failed because markets panicked. The truth is colder. The balance sheet was already cracked and the world finally read it. They didn't lose because of hysteria. They lost because the books couldn't breathe. Now zoom out from that single Monday. Picture the empire at its peak. Not a flag empire, a finance empire. Glass towers, polished marble, bonus season champagne. It looked like majesty built from pure intelligence. In that empire, money moved like weather. It fell from the sky as credit, and it pooled into assets. Stocks floated higher, homes climbed like vines, and everything felt priced in. The parade wasn't military, it was quarterly earnings calls. The streets were full of proof that the system worked. New cars, new kitchens, new degrees paid with borrowed years. Retirement accounts rose like sunrise, steady and unquestioned. Even skepticism started to sound impolite. But beneath the surface, the foundation was rotting, not because people stopped working, because the ledger stopped matching the story. And the ledger always wins. Every collapse has its costume. Sometimes it's gold and empire, sometimes it's tech and optimism, sometimes it's housing and family. The costume changes, but the skeleton stays. The same three warning signs keep showing up like fingerprints. The first sign is not a number by itself. It's a relationship that turns toxic. Credit starts growing faster than the real economy that must repay it. Debt begins sprinting while income walks. Credit is supposed to be a tool, like a hammer. Used well, it builds factories, ports, machines, and future cash. Used badly, it buys existing things and calls it growth. That's how the trap begins, with borrowed applause. Once that trap is set, it becomes an addiction. The system needs more credit to feel normal without new borrowing. The old promises start shaking. The monster is not recession, it's withdrawal, and the antagonist is never a general. It's a rate sheet, a lender, a bondholder committee, a market that stops clapping. The antagonist has no face, but it has terms. It doesn't hate you, it just collects. In the early 2000s, America's addiction had a friendly name, home ownership. It sounded like stability, like citizenship, like safety. But under the hood, it was leverage wearing a flag. Household debt in the United States surged toward $14 trillion by 2007. That number wasn't a trophy, it was a weight. The productive economy did not grow at the same speed. That mismatch is how insolvency is manufactured. Think about the scale of that. 14 trillion is not money in a drawer. It's obligations stacked into the future, with interest attached like teeth. Each month became a feeding schedule. This is where the first warning sign becomes visible to anyone who looks. When debt rises faster than wages, the system must invent miracles. It must either grow faster or refinance forever. Most empires choose forever. The second warning sign is what the excess credit does next. It doesn't spread evenly like rain. It concentrates, and it inflates asset prices until they detach from reality. Price and value stop being siblings. In the boom, detachment feels like genius. A house sells for double because the neighborhood is hot. A stock trades at a dream because the future is different. But the ledger asks a cruel question. What cash will pay this price? When prices outrun income, the economy becomes a stage set. The buildings look real from the street. Walk behind them, and you find plywood. The valuation premium is the hollow space. This wasn't new in 2008. In October 1929, Crowds gathered outside the New York Stock Exchange, staring at the machine. The faces were real, but the prices were fumes. When the fumes cleared, the fall took years. Back then, margin loans helped people buy stocks with borrowed money. Debt bought paper. Paper became collateral. Collateral bought more paper. It was a circle pretending to be a ladder. Circles always end at the same point. Japan ran the same script, just with different scenery. In the late 1980s, Tokyo looked like the capital of tomorrow. Neon suits, perfect trains, and the quiet confidence of a rising superpower. Then the Nikkei peaked at 38,957.44 on December 29, 1989, like a champagne cork at maximum tension. People remember that peak like a photograph. What they forget is the credit underneath it. Cheap money poured into stocks and land until the ground itself felt monetized. The empire wasn't built on concrete, it was built on collateral values. Now we reached a third warning sign, the one that makes collapses political. Financial prosperity splits from broad economic health. The numbers look great at the top while the street-level economy starts to suffocate. You can feel this sign before you can chart it. Wages flatten, yet rents climb. Grocery bills bite harder, yet indexes hit records. The system starts working beautifully for someone, and that someone is not most people. This divergence isn't just unfair, it's mechanically dangerous. When incomes stall, people borrow to keep life intact. Borrowing keeps spending alive, but it also tightens the noose from warning sign 1. Here's the feedback loop, in plain language. Credit inflates asset prices. Asset owners get richer on paper and feel safer to borrow more. Everyone else borrows to keep up, and the system calls it growth. The ledger sees it differently. It sees obligations rising, while the capacity to repay stays thin. It sees an empire eating its own future. And it notes the date, because it always notes the date. To understand how collapses actually happen, you have to stop thinking like a citizen. Start thinking like an accountant. An accountant doesn't care about speeches. An accountant cares about cash flow. Cash flow is oxygen. When credit expands, it can mimic oxygen for a while. But credit is not air, it is a promise of future air. When promises pile up, breathing gets expensive. This is why the most dangerous phase is not the crash. It's the calm before it, the blow off top. That is when every indicator smiles, and every warning is mocked. That is when the trap has the most bait. In 2006 and 2007, the bait was everywhere. Lenders offered adjustable rates like candy. Banks packaged loans into securities like sausages. Ratings agencies stamped them safe like a blessing. The real economy, meanwhile, did what it always does. It grew slowly, with messy human limits. It could not match the speed of financial invention. So the financial system did what addicts do. It found a stronger dose. By early 2008, the seams were showing. Not in parades, but in missed payments. Defaults rose in the weakest neighborhoods first, like the first cough in a crowded room. That's how collapses announce themselves. Quietly, at the edges. Then the timeline starts to spiral, because finance is a chain. A missed payment hurts a mortgage bond. A damaged bond hurts a bank's balance sheet. A wounded balance sheet makes lenders pull back, and credit tightens like a fist. In March 2008, Bear Stearns was shoved into a rescue sale for about $10 a share. Think about that number if you remember the old stories. A Wall Street name priced like a cheap meal. That's what insolvency does to pride. The system told itself it was contained. It always says that containment is the lullaby central banks sing to keep the patient from bolting, but the disease was already in the blood. By the summer of 2008, funding markets were turning skittish. Short-term lending began to feel like trust with a ticking clock. Banks looked at each other and saw shadows. In finance, shadows are enough. Now return to September 2008, because that's where the noir gets personal. Picture conference rooms with stale air and colder voices. Executives shuffled papers like they were moving scenes. Government officials stared at spreadsheets as if they were crime scenes. Lehman's books showed roughly $639 billion in assets and about $613 billion in liabilities. Numbers like that sound impressive until you ask the fatal question. How much of those assets could be sold for cash today? That is the only question that matters in a panic. Here's the rule of three, the tragic momentum you can't outrun. The collateral was suspect, the funding was fleeing, the buyers were gone. When those three line up, the system doesn't negotiate, it executes. In a healthy world, assets are real things that can be sold. In a credit boom, assets become marks on paper, dependent on continued belief. When belief cracks, prices gap down, and the balance sheet starts bleeding fast. This is where the first warning sign reveals its teeth. Too much debt means too many forced sellers. Forced selling destroys prices, and destroyed prices destroy collateral. Then collateral destroys credit, and credit destroys everything else. You can see this pattern in 1929, in 1989, in 2008. Different accents, same sentence. Credit outruns output. Assets detach. Society splits. Then the unwind begins. And the unwind is never polite. The smoking gun moment is not a gunshot. It's a document. It's the bankruptcy filing, the term sheet, the meeting minutes that quietly declare we will not save you. It's foreclosure, written in legal ink. With Lehman, the weekend negotiations turned into a liquidation sale. The rooms were full of people trying to sound calm while staring at a cliff. The brutal paraphrase was simple: find a buyer or become a lesson. Some wanted a rescue, because rescue preserves confidence. Some wanted a sacrifice, because sacrifice teaches discipline. But discipline is expensive when the whole system is leveraged. A moral lesson can become a mass grave. So the decision landed like a stamp. Chapter 11, Bankruptcy Insolvency Made Official. Not because the building fell, but because funding did. That is the moment the ledger stops whispering and starts testifying. The next hours were not just market hours. They were social hours. Money market funds wobbled, banks hoarded cash, and ordinary people felt the temperature drop without knowing why. That's what credit freezes do. They turn an economy into winter. Now the climax, the default, the moment money runs out. Not the moment the ATM shows zero for everyone. The moment the system refuses to roll over short-term debt, and the gears stop. Modern empires don't collapse with cannons. They collapse with no bid. Factories don't close because steel disappears. They close because purchase orders vanish, because financing vanishes, because customers vanish. The ledger is the unseen hand that can also become a fist. When credit tightens, everything tightens. People lost jobs, then lost health insurance, then lost homes. Heat got rationed, meals got smaller, and dignity became negotiable. You could watch sovereignty shrink at the household level first. That's the secret. Nations are made of personal balance sheets, and this is where you say the line out loud, because it is true in every era. Sovereignty is solvency. When you cannot pay, you do not choose. When you do not choose, you are ruled. After the fall, the empire tried to patch itself. New rules arrived like bandages after blood loss. In July 2010, the Dodd-Frank Act was signed, promising stronger walls around the same old machine. Walls help, but they do not cure addiction. The deeper story is older than 2008. In 1999, the Gramm-Leach-Bliley Act repealed key Glass-Steagall separation ideas and reshaped the banking landscape. Call it modernization if you like. The ledger calls it permission. Permission matters because incentives matter. If profit is immediate and risk is delayed, risk will be fed and profit will be harvested. That is not conspiracy, it is gravity. The system will roll downhill every time. So what do these three warning signs look like when you stop treating them as trivia? They look like a body with a growing tumor. Debt grows faster than the body's strength. Asset prices swell like inflammation. And the organs, the workers, get less oxygen. That's why collapses keep repeating. Each generation inherits a new story that says, this time is different. Different technology, different regulation, different leadership. But the ledger does not care about different. It cares about matching. You can even spot the emotional pattern. In the early boom, people feel hopeful. In the late boom, people feel entitled. Near the peak, people feel insulted by caution. Then, when the unwind begins, people feel betrayed. They did what they were told. They worked, saved, invested, and trusted. But trust is not an asset class, and it cannot be liquidated for cash. If you want the cruelest part, it's this. The last buyers into a bubble are usually the least protected. They enter at the highest prices with the weakest terms. When the crash comes, they absorb the hardest hit. Meanwhile, those with liquidity shop the ruins. Distressed assets become bargains. Foreclosed homes become portfolios. The collapse becomes a transfer, not just a loss. It was a theft, dressed as a cycle. Now we move into the generational aftermath, because collapses leave scars that don't show in headlines. Japan's 1989 peak took decades to meaningfully recover in sentiment and structure. The number on the index is one thing, the national psyche is another. In America after 2008, families rebuilt slowly, like walking on a broken ankle. Savings rates changed, risk felt personal, and the word mortgage became a ghost story. The recovery was real for some, but uneven for many. That unevenness is warning sign 3, still breathing. And the debts, the obligations, never truly vanished. They were shifted, refinanced, extended, and in many cases socialized. The ledger can move pain across time like a magician moves cards, but the cards are still in the deck. So here is the lesson, and you should hear it like a detective's closing statement. If you want to understand collapses, stop staring at the crash. Start watching the 3 signals that arrive years earlier. Watch the first relationship. Credit growth outrunning productive output. When the system needs constant borrowing to feel stable, it is already unstable. That's not pessimism, it's math. Watch the second relationship. Asset prices separating from the cash they can realistically produce. When prices require infinite optimism, they are one bad week away from reality. Reality always collects. Watch the third relationship, the split between financial victory and everyday survival. When the majority must borrow to maintain normal life, the system is eating its base. Empires do not survive by hollowing out their workers. Let that number sink in. Whatever number your era is worshipping. Maybe it's a market cap, maybe it's a housing price, maybe it's a national debt figure. Numbers can be holy or fatal. The ledger decides which one. You're not powerless, but you are not immune. The point is not to predict the exact day of the next collapse. The point is to recognize the structure before it completes itself. Literacy beats surprise. If this kind of financial history thriller is what you came for, subscribe because most people will keep watching the parade. We'll be reading the balance sheet behind it, line by line, before the music stops.